Welcome back. Big week for spending as Americans shell out on Thanksgiving travel and kick off the holiday shopping season. But our next guest says the country is dealing with an affordability crisis that shows no signs of slowing. Joining us is Mark Zandi, Moody's Analytics chief economist. Mark, agree there's a lot of concern about affordability and the gap is growing between high income and low income. And yet, what we hear from some of these retail companies and seeing some of the data is that overall, it's been pretty resilient, and there are expectations of a strong holiday shopping season.
Well, it's been okay. I mean, if you look at you got retail sales for the month of September, that looked pretty tired. But abstracting from the ups and downs of the monthly data, it feels like real consumer spending is kind of 2%ish, which is kind of right down the middle of the strike zone. But that hides a lot of differences. The folks at the top end of the income and wealth distribution, they're doing quite well. Spending is very strong. Folks in the lower parts and the middle parts of the income and wealth distribution, not so much. I mean, Sarah, just to give you a statistic, looking back since the pandemic, if you look at the spending by folks in the bottom 80% of the income distribution, it's just barely kept pace with the rate of inflation. So their real spending, their real purchasing power has gone nowhere. All of the action has been at the high end, the top 20%. That's where all the growth has been. So, yeah, the aggregate number is okay. In the middle of the distribution, you don't see a whole lot. But if you look at the distribution and the tails of the distribution, you see some pretty big differences.
So what do you see as the primary reason or driver?
Well, I mean, the affordability crisis has been long in the making. I mean, I think the pandemic and the Russian war go a long way to explain the higher prices for everything from food and healthcare, rent, childcare, elder care. But I think the thing that's really brought this back to the fore as an issue is the acceleration in inflation that we've seen since the beginning of the year and the weakening in the job market and income and wages since the beginning of the year. And I think that all goes back to deglobalization. It goes back to the tariffs and immigration policy.
I mean, as you say, it's a trend that has started well before that. You know, inflation certainly rose a lot coming out of COVID. So what's the policy response to this? I mean, clearly the administration is paying attention. They're starting to roll back tariffs on everyday items that you get at your supermarket that you can't necessarily grow in the U.S.
Yeah, coming into the year, inflation was decelerating. Job growth was strong. It felt like we were going in the right direction. Based on our modeling, it looked like inflation would have been, if there had been no change in policy at the beginning of the year, it looked like inflation was going to be back to the Federal Reserve's target, something that we all feel reasonably comfortable with by now, by the end of the year. Of course, we're getting something very different as a result of the policy. So if we want to get back on track, I'd say let's follow through on cutting back on the tariffs and kind of rethinking immigration policy and how we can get some reforms there. That's, I think, the quickest way to restore some semblance of affordability, getting inflation back to something we feel comfortable with and getting growth back into a gear that we feel good about. So those are the policies that would make the biggest difference most quickly. Now, there's lots of other things that could be done, but they're hard, on housing, on health care, on education, child care, elder care. There's lots of different policies that can be implemented, but they take a long time to come to fruition. The quickest thing is just backtracking on what got us here, and that's the tariffs and the immigration policy.
Right.